Welcome to the Iron Financial Explainer. We're here, as always, to help you forge a stronger portfolio, cut right through the market weakness, and build your wealth on bedrock, not sand. Today, we're drilling deep into PayPal's absolutely pivotal Q1 2026 earnings. Look, let's just be completely honest about the macro environment we're operating in right now. It is brutal out there. Persistent inflation is aggressively eating into discretionary consumer spending, elevated interest rates are acting like gravity, squeezing merchant operating margins, and the payment sector overall is under immense systemic pressure. So against that incredibly tough backdrop, we have to figure out the real story here. Is PayPal successfully laying down a solid, load-bearing foundation for the next decade of digital commerce, or are we looking at a structural value trap that's slowly sinking under its own massive weight? I'm your lead analyst, and I'm going to be breaking down the raw numbers, the revenue, the debt, and the margins. And joining me today is our market skeptic, who's here to represent you, the viewer. They're going to ask the tough questions, push back on the narrative, and help us find out if this is genuine heavy lifting or just more corporate hype. Let's get to work.
To truly understand what is happening at PayPal right now, you have to look at the massive architectural realignment taking place under President and CEO Enrique Lores. Guys, this is not a fresh coat of paint. This is a heavy construction project from the ground up. Lores took over a company that possesses incredibly valuable legacy assets. We are talking about a totally ubiquitous consumer brand, decades of hard-coded, sticky merchant integrations, and a massive global footprint that spans over 200 different markets. But despite that incredible scale, the actual execution was lagging. It was getting sloppy. Management has now explicitly stated they are taking deliberate, highly aggressive steps to sharpen their strategy, radically simplify the organization, and completely rebuild their cost structure. They're attempting to focus their capital investments exclusively where they are going to get the absolute highest impact. The goal? To actively put this entire company on a much more durable, fortified path to long-term growth.
Okay, hold on. Let me jump in right here, because we hear this exact turnaround and rebuilding narrative all the time on Wall Street. But let's cut through the polished PR for a second. As an investor looking at my portfolio, I have to ask the hard question. Is this turnaround story actually already dead? We've been hearing about PayPal's grand transformation for quite a while now. When you actually get in there and look under the hood, is this strategic shift forging a fundamentally stronger company, or is it just masking underlying decay in the core business? Are they legitimately building a brand new, impenetrable competitive moat, or are they just moving the deck chairs around while faster, much more agile competitors across the fintech landscape heat their lunch? Because look, a shiny new blueprint is great, but Wall Street is seriously starting to doubt the actual execution. I need to know if the actual structure holding this thing up is sound.
And that is a totally fair challenge. So to answer that, let's look at the historical foundation they've actually built over the last few years to really anchor our argument today. If you look at the progression from 2023 all the way through 2025, the structural integrity of this company looks incredibly solid. Let's talk scale. In 2025 alone, they processed a staggering $1.79 trillion in total payment volume. That was a 7% increase. To put that into perspective, that represents a massive, visceral chunk of the entire global e-commerce market flowing directly through their pipes every single day. Furthermore, their transaction margin dollars, which, let's be clear, is the absolute lifeblood of any payments business, climbed steadily from $13.7 billion in 2023 up to $15.5 billion in 2025. And their non-GAAP earnings per share followed that exact same upward trajectory, hitting an impressive $5.31 in 2025. Listen, hitting a $5.31 EPS requires serious, rigorous operational efficiency at scale. You simply do not hit those numbers or generate $6.4 billion in adjusted free cash flow if your core architecture is quietly collapsing. That is serious, load-bearing financial strength.
And that foundational strength brings us to the sheer weight of the Q1 2026 results that just dropped. Just in the first 3 months of this year, PayPal moved $464 billion in total payment volume. Let that massive number sink in for a moment. $464 billion. That is an 11% increase at spot rates and an 8% increase on a currency-neutral basis. Now, why does that currency-neutral metric actually matter for us? Because it strips out all the distracting noise of fluctuating foreign exchange rates and a highly strong US dollar, giving us a pure look at the true underlying velocity of the money moving through their network. And the fact is, that velocity is accelerating. This proves that the core engine is still doing some massive heavy lifting. Specifically, branded checkout grew 2% currency-neutral, which is a crucial improvement for them. Meanwhile, Venmo volume accelerated sequentially, posting 14% year-over-year growth, and their payment service provider volume, which includes the enterprise Braintree division, grew by 11%. So strictly from a sheer volume perspective, the reinforced concrete is definitely holding up.
Okay, fine. The dollar volume is massive. I will absolutely give you that. But let's step away from the dollars and look at the actual people.
the active users, because this is exactly where I see some very fundamental, concerning cracks in the data. You have 439 million active accounts. That sounds fantastic, right? Until you realize that number is actually down sequentially. That is a loss of 200,000 active accounts from the prior quarter alone. If the product is supposedly so sticky and this new foundation is so strong, why on earth are they bleeding out users? In a digital ecosystem, payments are notoriously sticky. Once a consumer links their primary bank account or a credit card to an app, they rarely leave unless the core value proposition is totally broken or someone else offers something vastly superior. Churning users at the top of the funnel is a systemic issue. On top of that, transactions per active account dipped 1% on a trailing 12-month basis. Yes, total payment transactions are up 7% year over year to 6.5 billion, but if the overall user base is slowly starting to erode, eventually that massive transaction volume is going to hit a brick wall.
I hear you, and I will readily concede that is a highly visible crack in the armor. And here's another one we need to address head-on, because we are looking at all the numbers. The transaction take rate. It declined by 6 basis points, bringing it down to 1.62%. Even if you exclude foreign exchange hedges, it's still down about 4 basis points. So we need to drill down into exactly why this is happening. It's largely due to a systemic mix shift in their business. PayPal is seeing massive, explosive growth in their enterprise payment segment, specifically the unbranded Braintree side of the house. But here's the catch. Unbranded enterprise processing is basically a highly commoditized game fought aggressively on price. It brings in absolutely massive volume, sure, but the profit margins are razor thin compared to the highly lucrative branded PayPal checkout button you see on websites. Add to that their increased co-marketing costs and the rewards they are paying out just to defend that branded checkout space, and you see exactly where the squeeze is coming from. Now, the silver lining here is that despite this squeeze, overall transaction margin dollars still managed to grow 3% to $3.5 billion. That was driven by solid credit performance and Venmo monetization. But make no mistake, that margin compression is a very real, very heavy pressure point.
Market skeptic. A pressure point? Honestly, it looks a lot more like a structural failure when you look at the Q2 guidance they just handed out. Look at this. The Q1 non-GAAP EPS came in at $1.34, which was a 1% increase. Barely a pulse, frankly, but sure, technically positive. But look at what management is actively projecting for Q2 2026. They are forecasting a high single-digit decline. We're talking approximately a 9% drop in non-GAAP EPS. On top of that, they are also forecasting a 3% decline in transaction margin dollars. I have to aggressively attack this narrative right here. If this new foundation is supposedly so durable, and they are executing this masterful turnaround blueprint, why are earnings projected to plummet so sharply in the very next quarter? Are they sacrificing their margins just to keep that massive volume pipeline full? Are they effectively buying revenue by artificially slashing prices on the enterprise side, just to keep the illusion of that $464 billion volume flowing?
And to really put this structural weakness into perspective, let's bring the heat and look outside the US market for a second. Let's look at what actual unadulterated market strength looks like right now in the global payment sector. We are literally juxtaposing PayPal's incredibly sluggish 1% Q1 EPS growth against sector peer PayPay over in Japan. PayPal is out here fighting tooth and nail for mere inches, just trying desperately to hold the line, while PayPay just took a mile, posting a mind-blowing 201% profit surge. When you look at the landscape and see a competitor printing that kind of explosive, unrestrained growth, it really makes you wonder if PayPal has simply become a highly mature, slow-moving utility stock rather than the high-growth fintech innovator it used to be.
Okay, let's add some vital context to that comparison, because as investors, we always have to read the fine print. Yes, PayPay's financials are undeniably explosive. For the year ended March 2026, their total revenue hit 380.7 billion yen, which is a 27% increase. Their adjusted EBITDA jumped an incredible 89% to 111.1 billion. And yes, they saw a massive 60.5% revenue growth in Q4 alone, but we have to remember the context. They are fighting a very different, much earlier stage battle in a completely different geographic market. They are still heavily in the aggressive customer acquisition land grab phase of their life cycle. Furthermore, that headline 201% profit jump to 117.8 billion yen, it was heavily aided by a one-time $57.5 billion deferred tax asset benefit. That is an accounting mirage. It's a paper gain, not raw cash flow generated from organic day-to-day operations. PayPal, on the other hand, is a highly mature, globally saturated network. They aren't out there trying to conquer entirely new continents anymore. They're deep in the optimization and margin defense phase. Their core cash generation is fundamentally sounder, even if it totally lacks those flashy, triple-digit percentage gains. And listen, it's not just PayPal feeling the heat of maturation. Look at PayPoint, another established legacy player across the pond. To illustrate exactly how complex optimizing a mature payments architecture can be, let's look at their net revenue mix. It shows shopping at 39.1% and payments and banking at 30.7%. Even they are explicitly noting in their recent financials that the market is changing at an incredibly rapid pace. They specifically highlighted the immense pressure to integrate emerging AI technologies into their infrastructure. Legacy networks are literally being forced to adopt AI for intense, real-time fraud detection, highly complex algorithmic risk scoring, and automated dispute resolution just to survive and keep their service offerings remotely relevant. Every single legacy payment network is facing this exact same systemic pressure right now. The reality of the industry is simple. You either aggressively diversify and integrate next-generation tech, or you get left behind. And that industry-wide reality perfectly sets the stage for exactly what PayPal is attempting to build right now to fortify their position.
This intense industry pressure is exactly why CEO Enrique Lores has completely ripped up the old floor plans and introduced a brand new three-pillar architectural blueprint for the company. Previously, PayPal was organized entirely around customer groups. Consumers over here, small businesses over there, enterprises in another silo. It created a highly tangled, incredibly inefficient matrix structure. And that matrix completely crippled them. It meant that launching a single, simple product often required getting sign-off and buy-in from multiple different regional and departmental managers, which slowed their go-to-market speed to an absolute crawl. Lores is aggressively dismantling that old matrix. The new structure features 3 clean, load-bearing lines: checkout solutions in PayPal, consumer financial services in Venmo, and finally, payment services and Clip. By streamlining this architecture, they are aiming to cleanly weld the two-sided network of merchants and consumers together much more efficiently. For example, they desperately want to turn Venmo into a central, unified hub where users can spend, save, invest, and borrow seamlessly, completely eliminating the internal friction that used to hold them back.
And here is the kicker. This new blueprint isn't just about making faster decisions. It's heavily focused on aggressive, undeniable cost-cutting. Management has outlined a firm expectation of achieving at least $1.5 billion in gross run rate cost savings over the next 2 to 3 years. How exactly are they pulling that off? Through a brutal, absolutely necessary simplification of the organization. They're talking about delayering management. For those who don't know, that is polite Wall Street speak for ruthless layoffs and systematically gutting the middle management bottlenecks that clog up the system. It takes serious operational grit to extract that much run rate savings out of a mature company. Alongside this delayering, they are aggressively deploying artificial intelligence across their internal operations to automate highly manual, expensive processes. They've even gone as far as forming a dedicated, enterprise-wide AI transformation team specifically to drive this initiative. But here's what you need to know. They aren't just going to pocket that $1.5 billion. The explicit plan is to take those hard-won savings and reinvest them directly back into product innovation, specifically aiming to strengthen the consumer value proposition and unlock brand new revenue streams.
Okay, reinvesting capital is a great story in theory, but let's look at how they are actually deploying their capital right now, today. Because from where I'm sitting, they've built a massive, heavy-duty defensive shield just to artificially support the stock price while they undergo this incredibly messy renovation. Look at the data. Over the trailing 12 months, they've dumped a staggering $6 billion into share repurchases. If you look at 2025 alone, they bought back enough of their own stock to reduce the average share count by approximately 7%. And on top of that massive buyback, they've also initiated a brand new quarterly cash dividend of $0.14 per share. Now, as an investor, obviously you love to see capital returns, but you also have to be critical and ask, is this just financial engineering? By retiring 7% of their total outstanding shares, they mathematically and artificially inflate their earnings per share metric even if the actual underlying net income stays totally flat. Are they just using their massive cash pile to prop up the stock price, buy themselves some time, and mask the highly uncomfortable fact that their core organic growth engine is actually stalling out?
And that precise tension brings us to the ultimate verdict for the Iron Financial audience today. We have laid out all the raw materials for you. On one side of the ledger, you have a literal fortress of a balance sheet. You have $464 billion in quarterly volume flowing through the pipes. You have mid-teens growth in the Venmo ecosystem. And you have a massive, aggressive $6 billion buyback program that is significantly reducing the float and rewarding shareholders. Right? But let's pause and actively look at the other side of that ledger.
Because on the other side, you have a real sequential bleeding in active user accounts. You have highly noticeable margin compression stemming from a systemic, unavoidable shift toward lower profit enterprise processing. And perhaps most glaringly, you have a highly bearish Q2 guidance that is openly projecting a 9% drop in earnings. What we have here is a classic high-stakes tug-of-war between incredibly deep value cash flows and severely deteriorating operational momentum.
Exactly. So the absolutely crucial point to take away is this. Despite all the turbulence, management has firmly maintained their full-year guidance, fully expecting free cash flow to come in over $6 billion. They are betting incredibly heavily that their architectural delayering and deep AI integration will successfully save that $1.5 billion and reignite organic growth. Market skeptic. But you have to critically ask yourself as an investor, is that $1.5 billion in future internal savings really enough to patch up a currently bleeding user base? If that turnaround timeline slips even a little bit, or if competitors continue to ruthlessly chip away at their highly profitable branded checkout margins, that supposedly solid foundation could very quickly become a structural value trap. And that wraps up our analysis for today. You've seen the hard numbers, you've seen the new architectural blueprint, and you've heard the very real risks involved. Now it's time for you to forge your own portfolio decisions. You have to weigh the potential of the blueprint against the risk of the bag entirely based on your own personal risk tolerance. So tell us, are you buying the blueprint or are you worried about holding the bag? Let us know. Stay focused, stay disciplined in this volatile market, and we'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.